Hi friends, welcome you all to another video. Today we will discuss about the basic accounting terms. Business transaction. Business transaction is an event involving an interchange of goods, money or services between two or more parties. The transaction can be as brief as a cash purchase or as long-lasting as a service contract, extending over years. Assets. Assets are resources owned by an enterprise which are expressed in monetary terms. Usually, assets are purchased or acquired for operating the day-to-day business for profit making. Assets are again divided into fixed asset and current assets. Fixed assets are assets which are purchased for long-term use and are not likely to be converted quickly into cash. Furniture, machinery, and land and building are examples for fixed asset. Current assets are also assets which can be converted into cash within a year. Debtors and closing stock are examples for current assets. Liabilities. Liabilities are obligations or debts that an enterprise has to pay at some time in the future. They represent creditors' claims on the firm's asset. Liabilities are again divided into two: short-term liabilities as well as long-term liabilities. Short-term liabilities are obligations that are payable within a period of 1 year. Creditors, bills payable, and bank overdraft are examples for short-term liabilities. Long-term liabilities are those that are usually payable after a period of 1 year. Long-term loan from a financial institution, debentures, or a bond from a company are examples for long-term liabilities. Capital. An amount invested by the owner in the firm is known as capital. It may be brought in the form of cash or assets by the owner for the business entity. Capital is an obligation and a claim on the assets of the business. It is, therefore, shown on the liability side of the balance sheet. Drawings. Withdrawal of money or goods by the owner from the business for personal use is known as drawings. Drawings reduces the investment of the owners. Revenue. These are the amounts of the business earned by selling its product or providing services to customers, called sales revenue. Revenue is also called income. Expense. Cost incurred by a business in the process of earning revenue are known as expense. Generally, expenses are measured by the cost of assets consumed or services used during an accounting period. The usual items of expense are depreciation, rent, wages, salaries, interest, cost of the heater, light and water, telephone, etc. Purchase. Purchases are total amount of goods procured by a business on credit and on cash for use or resale. Purchases may be cash purchase or credit purchase. Sales. Sales are total revenue from goods or services sold or provided to customers. Sales may be cash sales or credit sales. Stock. Stock is a measure of something on hand goods, spares, and other items in a business. It is called stock in hand. In a trading concern, the stock in hand is the amount of goods which are lying unsold as at the end of the accounting period is called closing stock. Debtors. Debtors are persons or other entities who owe to an enterprise an amount for buying goods or services on credit. The total amount standing against such persons or entities on the closing date is shown in the balance sheet as sundry debtors on the asset side. Creditors. Creditors are persons or other entities who have to be paid by an enterprise an amount for providing the enterprise goods and services on credit. The total amount standing to the favor of such persons or entities on the closing date is shown in the balance sheet as sundry creditors on the liability side. Profit. The excess of revenues of a period over its related expenses during an accounting year is called profit. Profit increases the investment of the owners. Loss. The excess of expense of a period over its related revenue is termed as loss. Loss decreases in owner's equity.